So what if you could actually get ahead of the market, not by trying to outsmart a bunch of trading robots, but by, using their own momentum to your advantage? Well, today, we're diving into a strategy called precision momentum, and it's designed to do just that in these crazy, fast-paced markets we're all in.
I mean, you know that feeling, right? That sense that you're just getting outplayed. You're trying to be smart, you're making your moves, but it feels like you're playing checkers against a supercomputer.
Well, it turns out that feeling is not just in your head. Our source material points out that a staggering 70% of all trades today are made by automated algorithms. Yeah, that means for every $10 moving in the market, 7 of them are being controlled by code. It's wild.
And that, right there, is the big challenge we're looking at today, the algo-driven market. But here's where we're going to flip the script. We're not going to see this as some unbeatable enemy. Instead, let's think of it as a new landscape, one that has rules we can actually learn and use.
And this really just nails the whole idea. You don't try to outthink the computers. That's the losing game. The real goal is to spot the patterns, see the big waves of momentum they create, and just ride them.
So, okay, if the plan is to ride the wave, how in the world do you actually do that? That's where the core philosophy of precision momentum comes into play. And it really just boils down to a couple of key ideas. The first big idea is a word you're going to hear a lot: confluence. This is the bedrock of the entire strategy. All it means is waiting for a bunch of different signals to all line up and point in the same direction before you make your move. It's all about stacking the probabilities in your favor.
So let's just walk through a quick example. Let's say you're watching a stock, and boom, a strong buy signal pops up on its 2-hour chart. Okay, that's interesting. That's your first clue.
But here's the key. You don't just jump in. You wait. You zoom out a bit, look at the daily chart, and see if that same bullish signal is there too. If it is, okay, now your confidence starts to really build.
And I love this quote from the source material because this is what traders are talking about when they say the stars align. It's not some mystical gut feeling, it's just a convergence of cold, hard evidence across different time frames.
All right, the second big idea here is capital rotation. Look, money is never sitting still in the market. It's always on the move. It flows out of sectors that have gotten really popular and expensive, what we call overbought, and into sectors that have been kind of ignored and are now a good deal or oversold. The strategy is to basically learn how to follow that money.
Okay, so that covers the why. Now let's get into the how. The source material lays out this surprisingly simple, 2-step playbook that puts all this philosophy into actual practice. And that's it. Seriously, just 2 steps. You start broad by checking the big picture to see which way the general market wind is blowing. Then, and only then, you zoom in and use your core tool to find that precise entry point. It's this simple, repeatable, top-down approach.
I absolutely love this analogy from the source. Step 1, checking that macro environment, is exactly like checking the weather forecast before you leave for a long road trip. I mean, you just want to make sure you're not about to drive straight into a hurricane, right?
So what does checking the weather actually mean for us? Well, you're trying to get a feel for the overall market's mood. You look at the big indexes, the S&P 500, the NASDAQ. Are they trending up or down? You want to be trading with that flow, not fighting against it. And then you add in the big economic news, stuff like interest rates or jobs reports, to make sure there isn't some huge storm on the horizon that's about to change everything.
So once the weather looks clear, then you move on to step 2, using your core tool. Now for this strategy, that tool is usually going to be a momentum indicator, something like the RSI, the Relative Strength Index. You can just think of it like a speedometer for a stock. It tells you how fast the price is moving and, more importantly, if it's starting to get a little too hot or overbought.
Now, one of the really powerful things about this approach is just how flexible it is. This is not a one-size-fits-all kind of deal. You can actually adapt it to your own style, whether you're a really short-term scalper, a long-term investor, or, somewhere in the middle. And this table breaks it down really nicely. If you're doing scalps, you're like a sniper. You're in and out looking for quick little profits. You might act on just a single signal, and you use what's called a hard stop loss, which is just an automatic sell order that gets you out if the trade turns against you. It's all about strict risk control. For long-term plays, you're more patient. You're waiting for that perfect confluence across multiple charts. And if the price dips a little, you might even buy more. And then you have those rare, high-conviction trades. This is when every single star aligns perfectly. Here, you might decide to use more capital or even tools like leverage or options to maximize your potential gain, but remember, that also maximizes your risk.
All right, so you've got the playbook. Now, how do you actually get good at this? Let's talk about mastering it. The source gives some fantastic tips for refining the strategy and some really critical advice for anyone who's just starting out.
To really sharpen your edge, you can add a few more tools to your kit. A volume indicator is great. It can tell you if a price move has real conviction, like is there a lot of money behind this move. You can use moving averages or EMAs to confirm the underlying trend. And of course, it never hurts to check the fundamentals. Even a quick look at a company's PE ratio can tell you if a stock is generally considered cheap or expensive.
And this next bit, this is absolutely crucial, especially if you're new to this. First, start small. Then, maybe even before that, paper trade. That's where you use a simulator with fake money. It lets you practice without any real risk. Keep a journal of your trades. Writing down why you did something is the fastest way to learn from your wins and your losses. And please, the golden rule. Only ever risk money you are truly okay with losing. That protects your bank account, and it protects your sanity.
So when you boil it all down, the single most important point of this entire explainer is this. The whole strategy is about replacing gut feelings and guesswork with a disciplined, repeatable process. It's about making thoughtful, evidence-based decisions time and time again.
Which really just leaves us with one final question for you. Now that you have the framework, are you ready to start trading with evidence instead of emotion?